Hello, learners. Welcome to our session today. I am your instructor, CPA Ringo Frederick. Today's session will be looking at financial management, and the concept that we'll be handling today is all about capital structure decision, a very important concept not only for CPA students, but in as so long as you're doing financial management, you'll find that you must be conversant with the concept of capital structure decision. So it is a continuation of what we've been doing. Of course, most of these videos, you can always access them in our application. So today's session, I'll understand of this question here that you can see besides me. This is a question which was attested in April 2023, question number 2B. That's the question that I want us to handle. But before we handle this question, let me take you back to, of course, what we did in relation to capital structure decision. What must we always be able to understand? So at any given point, when we are talking about capital structure decision, just a quick overview. These are capital structure decisions. At this point, it is important to understand, just as Mwalimu had told us earlier on, that for capital structure decision, you're looking at the component of our capital, right? Which will always constitute of both debt and equity component. On this case, key elements that you must always be able to understand at this point should be, you should be able to clearly compute the cost of equity, which cost of equity ideally being symbolized in that case, KE. And it is very vital to understand that under cost of equity, of course, we'll be talking about the concept to do with retained earnings. And of course, another key element we'll be looking at this point will be what? The aspect of ordinary shares. This is very important to note, okay? Then after looking at the cost of equity, we should be able, of course, to be able to understand the concept of course, cost of debt. And recall, when you are looking at cost of debt, this is simply KD. It is also very important to understand that we'll be talking of the debts that can be redeemed and those debts that cannot be redeemed, of course, in future. So therefore, it is vital that you should recall what we did about the redeemable debt and irredeemable debt. So after that, then it is important also to have a recall on the other component, which is the cost of preference shares. Cost of preference shares, of course, symbolized by KP. So after we've looked at this case, these are now what you're referring to as the components. Cost of capital. Components cost of capital. So it will be important to understand that all these, right, are what you are going to incur to raise the funds that will finance what? Will finance operations. And therefore, at this point, it will also be important to learn about the combined cost, right? And this is where we'll be looking at the concept to do what? Weighted average cost of capital, weighted average cost of capital, which in this case, recall, we are terming it as what? WACC. So the concept behind WACC is that we just want to look at, of course, the combined cost of raising these new funds to finance what? Existing projects, or cost of raising additional funds to finance the existing projects. So this is all about financing existing projects. You see, this is all about financing existing projects. This is very important to note. Then we'll also be talking about key concepts that we normally refer to as what? The weighted marginal cost of capital, WMCC, weighted marginal cost of capital. So the concept of WMCC is a bit different with WCC, because under WMCC, we'll just be looking at the cost of raising new funds to finance what? New projects. See, at this point, we'll be talking about financing our new projects, So these are what we should be able to understand in the event that you read about capital structure decision. So the question that we're going to handle today, of course, if time will allow, I want us to handle, of course, these four components. That is cost of equity, cost of debt, cost of preference shares, and talk about the weighted average cost of capital, the concept of WCC. So back to the question which you said, it is April 2023, question number 2B. Of course, I'm also going to project it on my screen in the event that you'll be required, or if at all you need to take a screenshot of the same, you can take a screenshot so that when Mwalimu is doing at this point, you're also following it, okay? So allow me to raise this point, then we jump straight to, of course, that question, so that you can see how easy these concepts always are, right? So projecting the question so that you can have a look at it. And this is our question projected here. I believe it's very, very, very visible. Believing that it is very, very visible. Of course, you can take a screenshot of the same. So going through this question, my good students, these are what you're told. That we're having this company where we're told the following statement was extracted from the financial statements of Rainbow Limited, of course, for the year ended at 1st December 2022. So in this case, what were we told? Clearly, you can see a good examiner has given us the capital structure of the firm, which the capital structure of the firm consisted of, number one, we can all see that we had, of course, ordinary shares, which we were given 750,000 shares of 20 shillings each. We also given the component of retained earnings. So for retained earnings, you're given a value there of 48,900. We also given, of course, preference shares, which in this case you're told that our preference shares was par value with a par value of 100, and the total value we had, of course, 5, right? 5 million, that is the case. Then, in addition, of course, a good examiner also had given us debentures, but debentures you were given as a value, 76,400. Looking at that case, my good students, continuation of the same. The most interesting part is on the additional information where we're told that, note 1, the preference shares were originally sold in 2014 at 104 per share. The current price is 94 shillings, although a similar issue can be made at 89 shillings net. So looking at that case, allow Mwalimu to explain that right now clearly. When you are looking at the exact value, because we'll be required to determine the market value of the same, so you'll find that the market value at this point is what you can get these shares at the market. So the market value, if at all I go to the market today, as much as it can fetch or as much as is going for 94, but you'll find that considering all other factors in play, I can get these shares at how much? 89. So this will be the value of this market that you can consider today, the true value of these shares. So in that case, have that in mind. Then note 2, a good examiner here had told us in note 2, having it at that point. Note 2, a good examiner told us that ordinary shares are currently selling at 38.4 on the securities exchange. So that is what they are currently selling. The debentures were sold in 2015 and realized at 6 per unit. The current price is 80, and it is anticipated that a similar issue will also sell. It is anticipated that a similar issue will also sell at 80 per unit. Okay? So you're given debentures here. And these debentures were issued in 2015, going at 96 per unit. The current price is 80, and it is anticipated that a similar issue will also sell at 80 per unit. Corporate tax rate is 30%. So in this case, remember, if at all you can check on the capital structure above there, we weren't given the par value of these debentures, but we were given just a whole value of the value that you're given there of 7.5. So it is important to note that it will be upon us, right, to get a clear value or par value of these shares, of these debentures. But the fact that you are told they were issued back then in 2015 and you aren't given the par value, So the best case will be for us to take the 96 shillings there as our par value as per note number 3. Last year's dividends amounted to 3 million, which was 70% of the net earnings. The company expects these dividends to grow at a rate of 6% per annum, and the dividends payout ratio to remain the same. So whatever that the good examiner is telling us here, a good examiner is telling us that, you know what, we have these dividends, which were we paid last year, the previous year, and the dividends that we paid dividends, total dividends of 3 million. 3 million, this is the value of debentures or of dividends that we paid. Yeah. So the question will be, if at all you are to required, or rather if we are required to determine the dividends per share, how are we going to determine these dividends per share? Then I need to get to know the total number of shares that we had on issue. So this will give us what? Our DPS, which we have to consider the same. Then we are told that new ordinary shares can be sold at 40 shillings. But in order to guarantee success, they will have to be sold at 35 per share. See, there is new share that we need to sell. And in this case, you can clearly see that you're given that for us to guarantee success, the true market value of these shares will be 35 and not the 40 shillings that we are given at that point. So clearly, you can observe that we have note 2 relating to ordinary shares, and we also have note 5 relating to ordinary shares. The question will be, Mwalimu, at this point, what are we going to pick? Which value of ordinary shares am I supposed to use here? We want to raise new funds, right? So in raising new funds, of course, the best case will be to consider issuing new shares. So the best case here in terms of the value of the ordinary shares that you're supposed to use, we are supposed to use for note 5, because this is relating to the new ordinary shares that we will be raising. So required here, a good examiner wanted us to compute number 1, the cost of preference shares, cost of ordinary shares, cost of debentures, and market weighted average cost of capital, WCC of the firm. So once given that question and once we've gone through the analysis the same, then things should be very easy on our end. So how are we going to work it out? This is how we're going to consider, my good students. Always have this in mind whenever you're having that. For you to earn all the points, being a quantitative paper, it is important that you start with your formula first. It is very important that you start with your formula first. So the first case, a good examiner wanted us to compute the, of course, cost of preference shares. I know very well that anytime I am required to compute our cost of preference shares, we're going to talk about our preference dividends here. We're going to divide by, of course, the value of what? The value of these shares. If at all I'm having any component of flotation cost, I need to take care of it. If at all I'm having any discount that I'm issuing, then I'll also have to take care of that. In our case, we didn't have all these items. All you are given, my good students here, according to note 1, of course, I'll be having the component of I'm having, of course, a value, which we've agreed it is 89. The key question would be, how will you determine your dividends? Recall when we started, we say that all times dividends will always be determined on the par value. So the dividends per share here, if I told you we were to determine our dividends, then my dividends in this case, I should be talking of on the par value, I'll be having whatever that you're given in our capital structure, 8% of par value. So I'll be having 8%. Par value here is 100, and therefore we can agree our dividends to be 8. So quickly, once you've noted that, just come and show the examiner that you know what you're doing. So you have your dividends, 8. You have the value, which it can trade right now in the market. It can trade at 89. So that is what you are taking. So I'm having 89. So therefore, we can agree that if I told you to determine then our cost of these preference shares, how much will we be having? I'd be having 8 divided by 89 to give us times 100, of course. I'm going to have what? 8.99%. Mwalimu is getting 8.99%. Kindly confirm on your end if you're getting the same values. After you are through with that, that should take us, of course, to the next element where you are asked to compute the cost of ordinary shares. So key E. Always recall that key E will always be talking about the retained earnings and will also be talking about what? The component of ordinary shares. So many a times, of course, if at all I'm not dealing with WMCC, in this case, considering only WCC, we have to focus on the ordinary shares. We have to focus on the ordinary shares. So therefore, to know or to determine the cost of equity, ordinary shares here, cost of equity, ordinary shares, that is what you're looking at. I know very well I should be able to get the expected dividends. With the expected dividends, I'm having the O, 1 plus G, that will give us expected dividends. We are going to divide by the value of our ordinary shares. We deduct any flotation cost or any discount that I could be having. Then I should not forget to add what? Our growth rate. I should not forget to add our growth rate. That is very important for us to note. So once we have this, my good students, of course, we proceed to the next item. The key element that I need to ask ourselves is, do we have these variables? Do we have these variables? That is what we need to ask ourselves. At this point, the O, this simply means the dividends per share, the dividends that we just paid, or the current dividends per share. Do we have this DO? I want us all to scan our eyes we take our eyes to note number 4. Last year dividends amounted to 3 million. Which was 7% of the net earnings. So the dividends that we paid last year, the O, this is, remember these dividends per share, of course. So we paid 3 million. And this 3 million that we paid on how many number of shares? If at all you can check our capital structure, you can see that our number of ordinary shares, you're given 750,000 ordinary shares. So I'll be having the 3 million. We divide by the 750,000 ordinary shares. This will clearly give us a value of how much? 3 million divided by 750. I can clearly see that I'm getting what? 4. So that is very important to note. Dividends per share, the dividends that we just paid, the previous year's dividends per share, we can see we're having what? We're having the value of 4. So with a lot of confidence, I can come and say that therefore my DO is 4 into 1 plus G. What are we given our growth rate? Of course, in this case, you're given our growth rate, which you're given, you know that the dividends will be growing at the rate of 6%, so that is 0.06. Okay? We are going to divide all this by the market value of these ordinary shares, which in this case, it is not 5. And we've seen we'll be taking what? Whatever that they were trading at right now, which was what? 35. So we take, of course, the value of 35. We are going to add our growth rate, which is 0.06, given the fact that we didn't have any, component of what? Any flotation cost, or we didn't have, of course, any discount. So therefore, this should give us a value of what? I'm having, of course, 4 times 1.06. We're going to divide all this by 35. Then I'm going to add 0.06, which in this case, times 100. Volume is getting 18.11%. Kindly confirm if you're getting the same values. Volume is getting 18.11%. You can confirm on your end if you're getting the same values with volume. After that point, we proceed to the next item where we are told to compute the cost of debentures. And the question that we're going to ask ourselves is, are we dealing with redeemable debentures or are we dealing with irredeemable debentures? In our case, clearly, we can see that in note number, that should be note number 3, check note 3 kindly. The debentures were sold in 2015 and realized 96 per unit. The current price is 80 and it's anticipated that a similar issue will also sell at 80 per unit. So we weren't given anywhere the component of maturity period. And if I'm not given anywhere the component of maturity period, I should know very well that we are dealing with what? We are dealing with irredeemable debentures or debt. So therefore, cost of debt for irredeemable, in this case, we should be talking of our interest. Should be talking of our interest. All of this you are going to divide by the value of the debt, if at all I'm having any fluctuation, and if at all I'm having any discount. I should not forget that we are looking at after tax. So therefore, 1 minus t. I should not forget that we are looking at after tax cost of debt. So therefore, 1 minus t. So in this case, my good students, you can all agree that our interest, Mwalimu guided us that interest will always be determined on the par value. Interest will always be determined on the par value. In our case, on that note, we've clearly agreed that because we weren't given the par value in our capital structure, but you're given the date that these debentures were sold, which was in 2015, and when they were sold in 2015, they were going at 96 shillings. So we're going to take that as our par value. So we're having 96 here. We multiply by the rate of this debt, the cost we are given, 10%. So therefore, we can agree that, therefore, the interest on this debt would be 10% of 96, which would give us 9.6. So here, Mwalimu is getting 9.6%. That is the interest, not 9.6 but 9.6 shillings, right? So that will be our interest. So therefore, clearly, we can determine our interest component here, and determining our cost of debt with a lot of confidence will say that my cost of debt, therefore, allow Mwalimu to remove this question now. I know by now we have it. So we will be taking, of course, the cost of debt to be my interest, which is 9.6. We're going to divide by the value of the debt. In this case, the market value of the debt, if at all you can see in our question, we had 80. So therefore, with a lot of confidence, you're going to have what? You're going to have 80 here. 9.6 of 80. I need to multiply by 1 minus t. The tax rate, we are given 30%. So 1 minus 30%, you can all agree, you're about what? 0.7. We are about 0.7. We are about 0.7. So therefore, it is our agreement that when we are talking about our cost of debt, this is now what we'll be having. We take our calculator. We have 9.6 divided by 80 times 0.7, which, my good students, you can see, times 100, we're getting a value of 8.4%. Mwalimu is getting 8.4. I don't know if you compute, what are you getting? We're getting 8.4%. So that is our cost of debt. That is our cost of debt. So once we have achieved this, the other question a good examiner wanted us to determine our weighted average cost of capital. Recall that anytime we talk about the weighted average cost of capital, we just want to look at the combined cost of raising these funds. And by looking at the combined cost of raising these funds, then we have to take an average of all these, then we add. And what will help us to determine that? I need to have what? My weight of each component cost. Say, for example, the first component is equity. So I need to have the weight of equity. I multiply by the cost of equity. We need to have, of course, our weight of debt. We multiply by the cost of debt. That is, of course, cost of debt after tax. We have to consider the weight of preference shares times the cost of preference shares. So summing this will give us what we are talking about, WCC. The most important question and the most important trick that you should understand at this point is determination of the weights. How are we going to determine these weights? To determine our weights, my good students, we have to use what? For the purpose of WCC, we have to use our market values. You see, so weights under WACC, we normally consider our market values of this component cost. And to know the market values, of course, of the component cost that you're looking at, you consider the capital structure. You consider the capital structure. So the capital structure, what you're given, of course, this is what you're given. Look at the capital structure for a firm. The capital structure for a firm, which in this case, I'll just have it below there. I want you to check your capital structure of the firm. We list it there. In this case, of course, you're having, number one, we have, of course, our ordinary, that is ordinary shares. We have our ordinary shares. We have the preference shares. Remember, the reason why we are not taking equity at this point, we are not taking the retained earnings. This is something, or rather, this is a component which is internal, and we can't issue it out. So anytime you're considering WACC, we don't take retained earnings. But when we'll be talking about WMCC, we'll always be talking about what? The retained earnings. So that is important to note, okay? So we take the other component, which is preference shares. We take our preference shares. And the other component, we take debentures. We take our debentures. So most important would be, how are we going to determine the market values of this component cost? All that we are looking at is that if at all I was to value this component today, if at all I was to value this component cost today, how much would they worth? Remember, we talked about the component of valuation earlier on. So we start with the ordinary shares. Ordinary shares, you can see, my good students, that we'll want to look at how many number of ordinary shares did we have. We had 750,000 as per what the good examiner had given us. Currently, these shares, they are going at how much? We can get these shares at how much in the market. In this case, you can see we had a value of what? We had a value of 35, right? That is what we had. So this will give us the value of these ordinary shares to be how much? Of course, I'll be talking of 750 by 35. Mwalimu is getting, of course, 26 to 50. Our values being in 1,000, I'm getting 26, 250. What about preference shares? If you check our preference shares, in that case, you are given each share per value was 100. So therefore, we take our 5 million, the value, we divide by 100 because it was going at that value, per value is 100. We multiply by the market value of these preference shares. The market value of the preference shares, you can see, which in that case we had, of course, to number one, currently they can go at how much? Currently they can go at 89. Currently they can go at 89. So we multiply by 89. That is what we can be guaranteed. So 5,000, of course, divided by 100 times 89. In this case, Mwalimu is getting 4450. You can confirm on your end if at all we are arriving at the same values. So I'm having 4450. Just confirm on your end. What about debentures? The same case applies. The value of debentures given in our case, according to our capital structure, we had 7.5. Yeah, we had 7.5. And we agreed that this per value of debentures, in this case, because we weren't given anything else earlier on, we take whatever that was issued on the first day, assuming that is what you're told. Not assuming, but that is what you're told. It was issued in 2015 at 96 shillings, right? But today, These debentures, they can go at how much? They are going at 80. So therefore, that will give us what? The market values. So that's the easiest way on how you can always compute the market values, because I understand majority of the students, they normally have an issue of computing what? The market value. So therefore, we take 7,500 divide by 96 times 80. This will give us 6250. So once we have the 6250, let us get the weights of each component. So plus 4450, 26,250. So in this case, I'm getting a value of 36,950. 36,950. So if at all this is our market value, I need to determine my weight then. To determine our weight, this will be very simple, because I need to determine what is the proportion of ordinary shares to our total. The proportion of ordinary shares to our total, we can see that at that point, all I'll be required to do is to take 26,250 divide by 36,950. In this case, I'm having 0.7. So we take this one to be 0.7. 4450 divide by 36,950. In this case, I'm getting 0.1. And finally, 6250 divided by 36,950. I'm getting, of course, that should be 0.2, right? So I'm having 0.2, because the weight, of course, will always equate to 1. So once we have our weight, we want to achieve the component of WCC. So this will be easy because I have our cost. The component cost for KE, or cost of debt, not cost of debt, but cost of equity, that is ordinary shares, we can see we had a value of what? 18.11. So I'm going to take 18.11, whatever that we had computed. Cost of preference shares, we had 8.99. And cost of debentures or debt, we had 8.4. See, so this one we multiply, so that as at the end of the day, our WACC, what will we be having? Do you really want Mwalimu to clear? Do you want Mwalimu to do this for us, and yet you have everything? Or you'll say like Mwalimu afanye kazi yake, right? You'll say Mwalimu maliza kazi yako umeanza, right? So let us do this. I know this will be very quick. The first case, I'm having 0.7 times 18.11, of course. In this case, I'm getting 12.68. 12.68. 0.1 times 8.99. In this case, I'm getting, of course, 0.90. Because it is 0.899. So that is the same as 0.90. Then, of course, we have 0.2 times 8.4. In this case, I'm getting 1.68. So if we sum it up, that will give us our WACC. If we sum it up, that will give us our WACC, which in this case, with a lot of confidence, then we can have a 1.68 plus 0.90 plus 12.68, which Mwalimu is getting 15.26. I don't know what you guys you're getting. I'm getting 15.26%. So Mwalimu is getting 15.26%. So this will be our WACC. So Mwalimu was taking us through all the steps, of course, of computing the WACC. And this is how easy this concept always is. So we have a lot of videos, of course, which you've done, and you can always get them, of course, if at all you're watching this video on YouTube, you can always get a lot of these videos in our application, which is app.mdarasa.com. app.mdarasa.com. This is where you can get all the videos for FM, of course, which will always help you to understand more of this concept. So in our next class, I want us to look at a concept whereby we are dealing with the concept of WMCC, the weighted marginal cost of capital, so that you can clearly get the difference between WCC and WMCC. To that point, guys, thank you so much, and I hope to see you in our classes. Of course, you can always reach us out on 0708 068 851. These are numbers that you can always reach us out with. So at this point, thank you so much, and I hope to see you in our next class. Bye-bye.